Yesterday, we received an update on the Australian labour market, and the data showed that it started the year with a bang, picking up right where it left off in 2024. January's labour force survey reported that 44,000 jobs were added last month, beating all expectations. After smoothing the data for monthly volatility, we see that employment is growing at a pace of 3% per year, which is quite a strong result by historical standards. At the same time, Australia's participation rate returned to a 114-year high. This tells us that labour supply has been rising to meet robust labour demand, and over the past 6 months or so, this has allowed employment growth to strengthen without seeing much change in labour market slack. Now, we did see a slight uptick in the unemployment rate from 4% to 4.1%, but this is mostly due to some recent shifts in seasonal patterns, with those people already having jobs lined up for February. In context, the current unemployment rate is the same as it was a year ago, while measures of underemployment, underutilisation, and youth unemployment have all moved lower over the same period. Earlier this week, we also received an update on wages growth. The wage price index increased by 0.7% in the December quarter, which was softer than what Westpac, the RBA, and the market were anticipating. Wages growth is now tracking at an annual pace of 3.2%, down from a cycle peak of 4.2% back in December 2023. Now, one of the main concerns for the RBA right now is the upside risks to inflation that is being posed by the current tightness in the labour market. The RBA's latest forecasts have the unemployment rate holding steady at 4.2% until June 2027. And together with their pessimistic view on labour productivity, they're forecasting wages growth to hold between 3 and 3.5% over the same time frame, which is a rate that they view as being inconsistent with inflation holding sustainably at the midpoint of the target range. But as we have seen in the data over this week, wages growth is easing at a faster than expected pace, and at the same time, the labour market has remained tight. While estimating the exact degree of labour market tightness is no easy task, we believe that the upside risks to inflation are not as grave as what the RBA's baseline forecasts currently imply. Assuming we're right about the labour market and inflation risks, we remain comfortable with our view for the continued but gradual removal of policy restrictiveness this year, with 3 more rate cuts over the next 3 quarters, bringing the cash rate to a broadly neutral level of 3.35%.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.